Welcome to another episode of Ben's Fireside Interviews. Today we've got Simon Davis, who runs his own family office, Astondown Capital. Simon started his career in the city as a corporate financier at Lang & Cruikshank. He then took over his family business, which was a small chain of pharmacies in the Midlands in the mid-90s. He, over the years, built it into a medium-sized national chain and exited in 2007 to the co-op. Since then, Simon's been building his own family office and running the assets himself. It's a medium-sized family office, and I think it's really interesting to hear the mechanics and the challenges and the opportunities that presents. Before we jump in and get Simon talking, if you're a viewer of this on YouTube, please give us the thumbs up and subscribe. That would be highly appreciated. But now let's jump to Simon. Simon, welcome. And tell us a little bit about yourself that I might have missed out, and then we can jump in.
Okay, I think you pretty much summed it up nicely in the intro. The pharmacy experience was unexpected, but at the same time very enjoyable. The growth of the business was primarily by acquisition, and the market was very soft at the time at which I came back to the business. And the journey was, as I say, very interesting. When we exited, the decision was difficult because it was a family business, but at the same time, it was the right decision based on market conditions and everything else that was presenting at the time. And obviously, the key thing for me at that juncture was my age. I was thinking about this yesterday. I was 39, and I think that it was quite an interesting time to pivot out of something that I've grown very accustomed to and into what proved to be like the Wild West, very unknown world.
That's an interesting, I think it'd be really interesting to delve just a little deeper into that. What sort of got you to that point? Was it that it was a competitive environment that drove the process, that it was, for instance, I was about to say prescription pricing that started to become a little bit more constrained for the business? Or did you feel that the size that you'd got it to was not quite right to take advantage of economies of scale and felt that was the point at which you should exit? Because as you say, it's both commercial but emotional.
Yeah, I think it was a bit of all of those, to be honest, or was a bit of all of those. For me, there was an issue to do with how expensive it was becoming to acquire businesses, and the nature of the market was such that you pretty much could only grow by acquisition. Growing organically was pretty constrained because of the licensing rules. So the prices had got to the point where I felt that they were unjustifiable on a business model. And then combined with that, looking through the industry, it appeared to me that I wouldn't say the gravy days because they weren't even that magnificent, but the times that were fairly favourable then were going to come to an end because the principal customer of a pharmacy is the government via the NHS, and they were putting the squeeze on. And I think the point we exited, which was in 2006, it came pretty quickly after that. 2007, 2008, there were a lot of changes to the way in which drugs were priced, and the consequence was that margin just got absolutely battered. That was on the commercial side. On the kind of logistics and organisational side, we were a small family business. Even at the end, when we had the number of stores that we had, 250 odd people, it still felt like a family business. And we were getting the economies of scale, but it was more a question of what was being expected of us as we grew into a larger organisation. And I didn't really want to move to that next stage where it all became a little bit remote from centre, became very much a function rather than the beating heart of the organisation. So I didn't want to see the business change by growing an awful lot more.
So let's jump now to the genesis of the aftermath, if you like, post-sale. Did you think about that event prior to the sale, or was it just 100% focus on the sale? So there was no prepping, if you like, or there was. And then maybe we can then jump immediately post-sale. What thoughts did you have about a family office or anything in that kind of regard?
Okay. At the time of the sale, it was very much about the sale. It happened very quickly. So from the point of making the decision to exit to the actual completion date was probably about 5 months. So there wasn't a lot of planning. There was also, for me, an idea that I might continue with a role of some sort, albeit a lesser role or different role, in the organisation that was acquiring us, but pretty soon that became apparent that it wasn't going to be a good fit. But also I had a spin-off idea that I was working on. So as soon as the dust had settled, there wasn't really much time for that to settle, we were already working on the other idea. And I wasn't thinking very much about the idea of family office or things that I was going to invest in and things that I was going to do. It was more a case for me then of, I finished this, have a breather, now I'm starting that. And that went on probably for about 18 months, 2 years. And I think the consequence of that was that I didn't really pause very much. There really wasn't a long pause to consider what I was going to do and then to structure myself to do it. It was being involved in something else and then getting sucked into other things almost by chance. And the idea of structuring, unfortunately, I don't think happened as it should do. And if I was looking back on it, I probably would have taken a much longer pause and tried to work out, given my age at the time and the fact that I was looking to do other things, what I needed to do, what was going to interest me, what I needed to have as resource to do it, and then try and think more logically about the way in which I was going to handle the assets that I had, or the cash and everything that had come out, rather than almost being swept along. So you were there at the time, and you will know that there was a lot of, there were things that were done at the very beginning, which to me sounded sensible, but on reflection, we look back and think it wasn't right for me. And I think that there's a lot of people, when you sell a business, will come in with financial advice, but they don't, you need to go beyond thinking about the finance and think about the individual. Who are they? What are they? What type of a person are they? What will they want to be doing? What will they be happy not doing? And I think that for me, I probably got, I wouldn't say the wrong advice, but I got advice that eventually ended up being quite difficult, because it was the sort of thing that would happen if you were retiring and just needed to effectively hand over control of your funds to somebody else, just enjoy your sunshine retirement. So there wasn't a pause, and I think there ought to be a pause, and there ought to be a pause to think about what it is that you want to do next and what structure you need around you to do it. And we got there eventually, as you say, because we've eventually set up a structure that does work, but there was a lot of unscrambling of things that were initially put in place that ultimately proved inefficient, expensive, and not appropriate to the sort of life I wanted to be living.
Yeah, I remember that time, and I remember also that it did take quite a while. In your mind, when did you feel that you started to stabilize around the structure post-liquidity event that you were happy with? And nobody's ever happy with anything ultimately, but that you were at least satisfied that it was moving in the right direction?
Probably took me about 6 or 7 years, I would say, to get it right. Oh, not right, to get it more appropriate for me. I think that once I realised what it is that I wanted to be doing, and I realised that I wasn't a particularly comfortable passive investor, I wanted to be involved in things and to have projects that I could sink my teeth into. I started to pull resource in that direction out of third-party management, and then getting it into, we set up a family investment company in 2015, if I remember rightly, so that was 8 or 9 years after. But there was quite a lot of planning before that, when we realised what it is that we actually wanted to do, and the assets that by then I had invested in and accumulated. And by then I was getting an idea of the sorts of things I was going to do going forward, and it was a question of trying to structure then, always with an eye a little bit to the advice that's coming on IHT and bits and pieces like that. But similarly, for me, it was all about flexibility. I've always wanted to have as much flexibility in what I do as possible. And as I say, the original structure was we were doing workarounds to do the things we wanted to do. There was always a workaround. So to get to a position where if there was something that I wanted to invest in, I could literally just write the check. That took about 8 or 9 years.
Yeah. Let's dive into now the sort of the investment world, if you like, in terms of, and I know you've got very strong opinions about public markets and private markets and levels of return and what the market and third parties have been returning for your portfolios. I guess the first question holistically is, what are your thoughts about public markets versus private markets and the sort of risk return that both present?
I think for me, you know that I get upset about volatility in the public markets and the fact that whilst one can try and invest in a way that is diversified in uncorrelated assets and all these sorts of things, there are still moments in time when you can get battered. And I think back to, in fact, the point in which we actually did pull a lot of money back from the main manager who was looking after the money was around 2009, when we'd been through 2008 and being told that the unthinkable had happened and the uncorrelated assets had correlated and all headed in the same direction. And I think that for me, the uncertainty that comes with the way in which public markets react to world events, I find uncomfortable. I appreciate that the returns over medium to long term will always be up there, but there's always, in the 20 years or so that I've been in this space, it has been a bit of a roller coaster. We've had so many shocks to the market. And for me, an average, I struggle with the idea of average returns when I'm making losses in certain years. The recovery is hard. And there's always this idea for me that there will be requirements that mean I have to take money out of the market to do something else, whether it's something fun or something business on the private side, and inevitably it's at the wrong time. You take money out at precisely the wrong time, and that's the nature of that market. For me, with the private markets, I think, going back to the public markets, the thing I do like about it, obviously, is the liquidity. I think it is, whilst the returns are there or thereabouts, and as I say, I always think I can probably do better in some of the things that I'm working on myself, the liquidity is fantastic. And the negative aspect of the other projects that I'm involved with is it's a very uncertain liquidity. Even the ones that you think you've got certainty on tend to get kicked down the road. And there'll be things where you think you're in for 3 years and you get locked in for another 5. And that can be really problematic when you're looking at inflation and other aspects that will start to undermine that investment. So I think I recognise that there is a place for public markets in the portfolios that we run. I think also as time goes on and you realise that it's not all about absolute return. So getting the best return isn't always the most comfortable life you can live. There's an awful lot of stress that goes into managing assets in the private space, and finding that balance and saying that a level of return over a prolonged period of time is acceptable. It doesn't have to knock the spots off things, but there's an acceptable level of return. That does bring with it some benefits.
What I want to do now is maybe jump into the way that you look at, if you like, your portfolio. And when I say portfolio, obviously, as a family office, you're going to have a grey area of things that are personal, like real estate, things that are not personal, but investment, i.e. real estate, and then private holdings, be they businesses that you run direct or businesses where, as you've said, you have a passive involvement with, and then there's public markets and all of those sort of things put together. Do you ever look at the whole picture, that our world holistically, and decide what your asset allocation, almost like a professional institution would? Or do things happen to you as they go along and you're not thinking about specific exposures?
I wish I could say I'm better organised and I do think about asset allocation, but I don't. I tend to find that what I'm really looking at is, a lot of the time, is duration of investment and then the requirements that we as a family have and how they'll be met. given those parameters. So historically, trying to find income earning assets wasn't really important to us. We tended just to draw down out of available funds. These days, as in the last probably 5 years, I've tried to create more income earning assets and just parking, knowing a chunk of money is part that will generate the required income. And outside of that, I'm probably more concentrated than I should be in a very small number of assets, because they're the ones I feel most comfortable with. So the bit that I put aside to public markets, which is, I was looking at this the other day, is probably all in all around maybe 30% of the family office's assets. That's the bit I hand over. Everything else I'm interested in, concerned for, or have that sort of entrepreneurial push towards. So I am concentrating on in certain spaces, and I know that brings risk, but at the same time, a lot of what we do is, I like to think, fairly secure. The private equity side of stuff that we have done in the past is probably shrinking. The direct private equity that I've done, there's those, as I said to you before, where I'm very involved, and there's only so much of me that can go into these things, and therefore there probably won't be more of those. And the private equity type or venture capital type investments that are made through funds, again, with those, there's been a space for those, but I've not been blown away by how the whole fund operates and the times that go with it, both in terms of drawdown and in terms of repayment and the length of funds that always seem to be extending. So it's probably something we won't do again. We'll find ourselves into things that have a more finite end. And then, again, as I like money to be working, the idea of money sitting as a safety net, I should have, but I'm not particularly good at it. And therefore, I think that I like to know that when something is invested, it's gone on day one, it goes out for a period of time, and if I want it back, I can expect it back on a certain date. And obviously some of the private equity stuff and the fund stuff just doesn't play to that tune.
No, it doesn't. And as you say, duration is extending and IRR is falling, and even DPIs, DVP, all those good things are just getting worse and not better.
Time is the worst enemy to all of these things, isn't it?
Absolutely, the time decay effect. Now, it's interesting to think about potentially as a family office and with your kind of day-to-day requirements, what do you think is the right level of yield, if you like, on an annualized basis? If you consider that long-term inflation nowadays is roughly around 3% or so, and then you want to add to that the sort of return requirement for daily life for a family, what do you think is the adequate level of return that you should expect year in, year out?
I would say somewhere between 7 or 8% is the number that comes to mind as an average. There will be things that obviously outperform. There will be, there's things that disappoint. And I know we're certain of the property investments, unless you're benefiting from, if you're just living off the yield of a property, those sorts of numbers feel unachievable unless you've got some decent leverage in there, and with interest rates where they are at the moment, even that is disappearing. So I think probably 7 or 8% with that. I think when we started and we were putting targets on some of the money that was being managed by third-party investment managers, we were talking about CPI plus 3. So maybe I'm thinking it ought to be a little bit more than that, and that was them lowballing where they could exceed my expectations.
And we've talked about sort of equity largely, both in private and public, but I know that you also like direct lending. What are your thoughts on direct lending? What are the challenges and risks involved in that? And do they give you those sort of returns that you're looking for?
The returns can generally speaking, have been very steady in that space. The risks obviously are time. Yeah, direct lending for me has come in two forms. It's been lending against property assets or lending against business assets. And on the property assets, the problem has always been time. They've always worked given enough time, but it's time and overspend and everything else that goes with it. And I did realise fairly early on that I I didn't like the risk of being behind other lenders, where I was taking mezzanine slugs of transactions, and whilst the return obviously was more attractive, the vulnerability to anything going wrong was too high for me. So we ended up finding smaller transactions where we could do the equivalent of a unitranche or whatever to make that work. So the returns have been fine. I think the corporate lending for me is more interesting. Find a sector that you feel comfortable with and start to build up some sort of understanding and expertise in that sector. And then a lot of these businesses are without gearing of any sort, and finding the right sort of business in the right sector which is looking to grow and has the right management team. But also, I suppose with some of the corporate lending, the exit is a little less certain in theory, because with a property transaction there's usually a plan of building, selling, whatever. With the corporate businesses, much as they might talk about what their plan is, that will change as opportunities present themselves. And we're still in the middle of the cycle of those loans anyway, but we're pretty confident that we're putting money out for 5 years at fixed rates, and the exit for us it should be because the business has either managed to accumulate the required amount of cash or has grown sufficiently that a refinance is very much on the cards, because they no longer are at that early stage development where they were when they came to us for the money.
Right.
So the returns are there, and as we are doing quite a bit of that, but there is demand for it, but it's always an established business that's making a decent amount of profit to start with, but has ambitions to grow quite quickly, which its balance sheet otherwise wouldn't permit, and where regular lenders do not see the value or do not see the security that we see by understanding the sector.
And this is a wonderful sort of point that you make there, because family offices are in that position, are in a flexible position that they don't necessarily have to go down a single route, whether it's in credit or it's in equity or private equity, whatever it might be. You can have that level of flexibility and react to market conditions, which I think is fantastic. In terms of getting those entrepreneurial juices flowing again, have you done a number of activities where you are taking total control of that business, and what's happened in those? How have you managed to build those businesses?
I've done it once or twice. Sometimes it's been very painful, because I've gone into situations where the businesses have been in a bit of a mess at the start. And I think it just takes, again, I think the idea that you can effectively drop into any sort of business having had a business background is a bit of a falsehood. I think there is an awful lot of learning that needs to occur about the nuance of anything that you're dropping into. Once that happens, and as you say, the entrepreneurial juices get going, I think it once again becomes a passion. You can be interested in the most bizarre things if you've got money invested in them. I think that the thing that's harder probably is going back into what is a small business, because we don't have the capital where we'll be buying into very large businesses. So inevitably you're buying into a small business, which, if you are going to try and make interesting things happen there, you have to recognise that you've got to go through all those growing pains again. And I had forgotten probably how lucky we were at the end of the last business, at the pharmacy business, because a lot of things had been done already, and we had a kind of well-oiled machine that was going forward and was able to spot the opportunities. I think in a smaller business, trying to identify opportunities to grow organically probably are easier than some of the acquisitions. Getting banks to believe in you again, it is difficult, because the reason people are looking to borrow from our family office on the one side is the same reason as our own businesses are struggling to go to banks and raise money that way. So it's an odd place to find yourself, because sense says don't keep throwing all your own money into one idea, and we should be bringing on board cheaper debt if we can do it, but we have to recognise the fact that these businesses can be relatively small. So it's exciting, but it is, as I say, it's quite a lot of work.
Simon, I've got a couple more questions for you in terms of, do you think about legacy, succession, generational factors, or it's not so much of an issue from your perspective, or you're just way too young and healthy and fit to think about such matters?
I never intended thinking about legacy. I remember having the conversation with my mother at the time, and we were always determined for this not to be a legacy thing that we were building, and that the next generation would be able to survive on their own 2 feet. The reality is they can, and I'm sure they will, but whether or not they choose to become involved in the things that I do, that has been changing. I think you're aware that I have one particular of my offspring who happens to have time available, and we are working together now, and it's really nice. And the idea of, it's different when you have a family business. It's obvious within a family business often that somebody will join, they will have grown up with the business, they'll understand it, they'll have a fondness for it and everything else. With the family office, it's much more difficult, because I know when I started to explain how many investments we have and what they are, and what I want them to do, it is a bit of a mind spin, and it isn't necessarily interesting. I think it is easier to bring people in to say, help me with a project, than it is to say, this is the whole. Do you want to get involved in it? Because each of the investments is so personal as well. It's personal and interesting to me doesn't mean it will be personal and interesting to somebody else. And I think because we are as spread in the things that we do, I think it would make it difficult, straight up, for the next generation to come into doing the job that I currently do. I could see situations where the offices, or where there are businesses that we are involved with, where other members of the family might choose to get involved in those. And I think as I do get a little bit older, doing less obviously is appealing, but at the same time, trying to get your children interested enough, because they want to have careers. And I think it's hard to say it's not a career, but it isn't really. This is a life, not a lifestyle. It's a way of living in the things that I do, but it's not a very focused career. And I think that certainly for the next 5 or 10 years, the next generation should be thinking about developing those careers. And if they end up saying they want to do something more akin to what I'm involved with, then it will be open arms.
Wonderful. And then to finish off with, and I specifically kept away from politics and economics in the UK, but maybe as we finish up, and I'd love for you to give some advice to new family offices that want to establish themselves or restructure themselves. So if you talk a little bit about that, but in the context of the current economic environment in the UK, what are your suggestions? How would you encourage people to move forward?
Obviously, it's difficult in the UK at the moment. Lots of people are talking about leaving and all of the dangers of being here. I think that from a financial point of view, the UK is as good a place as any to be operating from. I think you can set up a structure that's not massively complicated. It doesn't have to be massively complicated, and it doesn't need to bring with it too many layers of regulation and everything else to make it work fairly simply. And I don't know whether that's always the case if you were going to be based somewhere else. I think that the advantage of the family office structure, or certainly the family investment company structure that is available to all, in times of uncertainty with taxation and government plans, the ability to turn on and turn off how and or where you create income and profit and wealth, I think is something that needs to be properly considered. I feel that some of the off-the-shelf products that perhaps you could buy into, like offshore bonds and things like this, they sound incredibly useful at the beginning. They absolutely, and in fact somebody was trying to sell me another one of them recently. They definitely have their place. There are ways in which you can effectively defer an awful lot of your hard decisions till later, but I don't necessarily think that's the right way. I think that ability to structure assets and to plan for IHT and bits and pieces like this that can exist within a family office offer far more flexibility. over a period of time, whilst particularly as generations change and we all start to think about how much control we want to have versus how much of a liability we want going forward for IHT and so forth, a family investment company, family office structure does afford an awful lot of benefits there.
Brilliant. Simon, thank you so much for taking us through this journey. Really interesting, and wish you well in your continued businesses, and hopefully we'll get you back on soon again.